Hello, and welcome to a Bytetree webinar on Bitcoin and gold in 2025. I'm Kit, I'm the senior analyst here, and I'm joined by three wonderful guests. There aren't many Bitcoin and gold fund managers in the world, but we've gathered three of the very best here today. Firstly, Mark Valek, who is an Austrian both by blood and by economic philosophy and runs the Incrementum digital and physical gold fund, where he is also a partner. He's written a book on Austrian economics for investors and is a co-author of the annual Bible on gold investing, the In Gold We Trust report, which has been including a chapter on Bitcoin for some years now as well. Then we have Jeroen Blokland. He was the head of multi-asset at Robeco, a large European asset manager, before launching his own research, and then the Blokland Smart Multi-Asset Fund, which we'll be talking about today. He has a large following on Twitter and is highly regarded for his macroeconomic insights. And finally, we have our own CIO and founder, Charlie Morris. He is the creator of the Bold Index, which is tracked by an ETF managed by 21 Shares in Zurich. He was formerly the head of absolute return at HSBC Asset Management and writes the multi-asset investor at Bytetree now. He's been a gold bug since 1999 and a Bitcoiner since 2013. Thank you to everyone who has tuned in today. One key thing to say before we go on is that nothing on this webinar should be treated as financial advice. Secondly, if you would like to ask a question to our three speakers, please type it into the Q&A box and we will get onto some of them at the end. Now, we're here to talk about Bitcoin and gold. And Jeroen, I'm going to turn to you first and ask a simple question, which is why? What problems do investors see that lead them to these assets?
Oh, well, so I have a traditional investment background, and I guess it's the problem that a lot of these traditional investors do not see. I was raised in an environment that you only need two asset classes with all kinds of flavors, equities and bonds, to create a healthy, attractive multi-asset portfolio. And I don't think that is true anymore. Because one of the two asset classes, bonds, will not provide the return that is required to have to reach your financial targets or whatever. The reason for that is extremely simple. We live in a debt-driven system. You can see that literally everywhere. Every time there's a need for some additional expenditures or whatever, debt is involved. And that means to prevent this debt-driven system from collapsing, it's pretty easy what should be done, and that is to keep interest rates low, structurally low. Central banks are the ultimate tool to do that, and to make sure that inflation is not too low, but better, even a little bit higher. So if you add low interest rates and higher inflation, banking accounts, savings accounts, and bonds do not provide any decent return anymore. And I also think this is the next phase that traditional investors should do, is to present their returns, their performances in real terms, in terms of purchasing power, because then you will see that bonds do not deliver anymore. That means bonds are abundant, and then you have to invest in the exact opposite. So you look in the dictionary, what is the exact opposite of abundant? That is scarce, and therefore my fund invests in scarce assets, with two main examples being physical gold and Bitcoin. But I also believe that quality stocks, or a subset of the equity market, is also scarce, and you can add that as well. So in a world of debt abundance, invest in the opposite. That's the simple idea.
Brilliant, thank you. If I could turn it over to you next, maybe Mark. For thousands of years, people would have only turned to one thing to solve the problems that Jeroen talks about, but now there's a second one on the block. So if you could start by maybe talking about how gold fits into that debt-driven problem Jeroen described, and then just factoring in where Bitcoin started to come into the conversation as well.
Right, so gold has developed in a natural process, in an evolutionary process actually, or in a market process, one could say, as money in a decentralized form without any legislator basically forcing the population to use it. And so gold became money all over the world, and now we've been in a very strange situation in the last 6 decades almost, I'd say, where we have this totally unbacked monetary system, debt-backed monetary system, and this is actually the exception to the rule. So we are operating actually in a very exceptionary times, which has been accepted by the mainstream investors because we actually don't know a different investment environment as we are here together. We only know it because we, and I guess that holds true for all of us, are somewhat or pretty well read, maybe in financial history and monetary history, and we've studied, we've looked into that, and maybe there's also there lies the difference between say hard money investors, sound money advocates. They have financial knowledge about the history. I think it's actually a quote by Ray Dalio, if I'm not mistaken. If you don't accept gold, you're ignorant to history, and I think that's quite proves the point. So gold has been money, and gold now in this exceptionary environment, debt-based pure fiat money environment, is kind of floating at the sidelines and being kind of inflated with the fiat money inflation, and not many people understand it because it doesn't pay interest, and that's, I think, one of the biggest conundrums for them to basically figure out how can one actually justify having an asset in a strategic asset allocation which doesn't earn any interest. But again, thinking out of the fiat money box only really, I think, enables you to do that and wrap your head around it. And once you do that, and once you actually also come to the conclusion that this debt-based system is probably in a, I'd say, critical phase by now, I think, and that's also what our main message for our this year's In Gold We Trust report was. I think one really can justify a lot larger allocations towards gold and potentially also Bitcoin than in an environment where this debt system just like kind of is still in a relative stable manner. So we wrote the big long, and this year that was our leitmotif of our In Gold We Trust report, pointing out to people, perhaps reconsider your generally accepted views on asset allocation, and maybe you want to really considering to have a much bigger allocation towards gold and potentially Bitcoin, which we then I think also can talk about still specifically.
Indeed, and we spoke to Russell Napier recently on a previous webinar that people can see, and he was also talking about exactly the same issue, which is the debt-driven cycle, the incredible amounts of public and private debt, and what can happen when those things start to unwind. So Charlie, with your both multi-asset research and Bitcoin and gold hat on, the risks that investors have to face today are leading people to Bitcoin and gold, and you have large allocations there. Do you want to touch on that?
Yes, I mean, I like to go back 25 years when I first picked up on gold, and I was a new boy in the financial services industry, and I went to some presentation, and it was something that wasn't really talked about. We didn't have the ETF yet, and people were talking about gold being the hedge against monetary inflation, or really inflation in those days more than monetary, and it was, you know, it hedged a risk that may come, and you know, it's happened. It's actually happened. This thing that we thought might happen 25 years has happened. Most major governments are maxed out. As Russell Napier said last week, if the government's not maxed out, the private sector in the same country probably is. And so you find that these situations, there's very little wiggle room in the system to do the right thing. And I think successive democratically elected governments have just spent money that they haven't got. And so we're now really at the end of the road here. And limited supply, as Jeroen said so eloquently, is an important thing because bonds are unlimited supply. And I just want to say the other thing, actually, it's just what a pleasure it is to have Mark and Jeroen in the room. I've met both of them personally, and I think we painted Zurich pink on different occasions. And so I'll go back to you, Kit.
Yeah, well, I don't know if we want to hear too many more details on Pink Zurich, but just wanted to talk about allocations. And Mark, you talked about the study of history. Currently, there's a lot of talk that gold is a crowded trade, that fund managers are overly bullish on it. But when you compare it to history, are the allocations of maybe the institutional investment world or central banks, how do those compare to 50 years ago in the 70s when inflation was a problem the last time?
Mute.
To Mark, if you're
sorry. Right, I think that's the most difficult question to tackle for most of investors currently, because nominally, obviously, the prices are close to all-time highs. And interestingly enough, especially with equities, I think people don't have that much problems investing close to the all-time highs. But with gold, they seem to have more considerations. But I think again, that's probably a function of the general critical mindsets toward precious metals. I think what one clearly can say about the last 2 years, or let's say 18 months of the gold market. First of all, one really can observe that this period has been quite exceptional. So the performance has been pretty strong, also in historic terms. So it may not have been the strongest 18 months since the free float of the gold price, but really 45 percentage points. Now we've been like on a 12 years rolling basis, I think, for pretty much the last 6 months. So with 45% in dollar terms performance, that is for gold strong. I think one fairly can make that point. So I wouldn't want to go into like betting if now, particularly now, is on a technical basis the best point in time. That's always a very difficult question to answer. But what we can say about this bull market for sure, and I think that is very obvious, it has been definitely mainly driven by central banks. Central banks and Asia also, not only the central banking demand from Asia, also more general demand from Asia, I think China also specifically. But what it not was, it definitely was not driven by the Western financial investor. And the Western financial investor, I think, was for the like the past two decades, since until to 2022, the marginal investor, as we always like to describe it. And I think that becomes quite clear if one looks at the aggregate holdings of gold ETFs and the gold price. So you had quite a nice correlation between gold ETFs in the West, mainly in the US. They are used as a vehicle for investments from the financial institutions from the US and in parts also from Europe. And so they were always like investing according to real rates. So if real rates were going down, holdings in ETFs went up, and correspondingly the price in gold went up, and vice versa. And this correlation actually broke in 2022. So we wrote extensively in our last In Gold We Trust report, which we called the New Gold Playbook, and where we pointed out exactly this. So central banks have been driving the bull market for now. Lately, Western financial investors started to join the party a little bit, but I think in historic terms, and also if one looks at their allocations, they actually haven't been participating, which is a pity for the public, because I mean, it's pension funds, it's the big insurance companies, it's really the great pools of capital which are sitting on bonds a lot of times, and basically cannot or don't want to have significant gold exposure. So I think they will be also badly hurt. But point being, Western financial investors really haven't been participating a lot, and I think there lies also the big upside still, because still at the end of the day, I think the largest pools of capital are found specifically in the US and the West, if you want to extend it to Western Europe. And I think we saw something similar in the 70s, where the last gold bull market really went ballistic, when actually these financial pools started to basically join the party in a significant manner. And we're still, in my view, pretty far away from this kind of scenario.
Yeah, that's really interesting to hear. And there's obviously the allocation element, and you just touched on sentiment at the end, which I know, Jeroen, was a big part of your analysis when you were writing macro research as well, and figures into how you run your fund at the moment. Do you have specific sentiment indicators that you put together when you look at the gold market, or is it only things that you use for the stock market or for Bitcoin as well?
No, for gold, we do not use any, let's say, traditional risk management tool. We do for Bitcoin and equities, because we want to compete with the traditional 60-40 portfolio, and that has an average or neutral risk. This is also what a lot of clients like. In the end, when they have to choose, they end up in the neutral bucket, unless they're very young. For the other two assets we have, for gold, we tested some of these indicators, but because it's, let's say, the safe haven, the haven asset in political turmoil, market turmoil, you see that these traditional indicators actually do not work. We tested them extensively. Because gold in itself has this intrinsic hedging characteristic, right? So no, we don't do that, and we also know that from time to time gold can stagnate or even go down for a couple of years sometimes. But in the end, every time when money goes to the ceiling of what is conceivable relative to some kind of store of value. You see, I think that Mark explained that very well. It's the last 60 or 70 years that are the exceptions. Before that, we saw every time the same pattern happening, that in the end, some store of value, almost every time it was gold and sometimes silver, was the core of the financial system. And every time that people thought of smart things to get away from that, it worked for a while. And then either a crash or a crisis or a reset, whatever you want to call it, put them back to the starting point again. And that is that gold is the first part of the pillar of the financial system. Maybe if I can, on the traditional finance world, moving into gold, there is literally zero movement happening. So we are now starting a pension-related fund. So same philosophy, but for people to have an attractive pension investing scheme. And there, some of my partners, but also we did themselves, we asked traditional investors, would you like to add gold/physical gold to your asset mix? Because if you put them in your traditional mean variance models, the way they optimize portfolios and derive an asset allocation, there's no, so if you put gold statistics now in such a mean variance optimization, gold has now beaten bonds back to 1970. If at one point it will spit out a certain allocation toward gold, can be 5%, can be 10%, can be more. I think Mark and his colleagues also looked at it's a little bit high, even if you optimize it, but it's not, definitely not zero. But then still, we should not forget these companies are built on two pillars, equities and bonds. So whenever they start saying, yeah, but bonds are a bad investment, they basically have to rearrange half of their company with all the fixed income people in it. And this is, you should not underestimate how stubborn this is, especially if you have shareholders. So even though the numbers cannot explain why these traditional investors are not moving, their business model can. And I think this is something, this is what I like to call the great rebalancing. every day some investor will wake up and see, okay, I cannot for my clients, but also backed by the data, I cannot hold on to this 2-asset world. I have to change it. But I think the first reaction of most of those traditional investors will be, we won't do it because it hurts our business model and we have to fire people or skip fees and things like that. And I think that is a very interesting or a very important part to not underestimate, even though the data is so bloody obvious to say. Yeah? So that's a strong trend that I encounter again and again.
Yeah, that's really so interesting, because it is a big question of why sort of Western institutions haven't been following central banks in Asia into the market in the same way. But just to touch again on the point that Mark made, and I want to come to you on this, Charlie, about the correlation with bond yields that broke down in the last few years. I know that's something you looked at closely, and just wondered whether you want to sort of expand on how you're looking at gold, how you're thinking about valuing gold now that that correlation has broken down.
Yeah, it's a very good point, because it was so tight, that correlation, for so long. You know, from the day we had break-even data in the late 90s all the way through to really the war in Ukraine. And I think, you know, something changed at that point. And then the overwhelming thing about the gold price the last few years, as has already been said, is the central bank accumulation, which, as the ECB pointed out recently, has, you know, the central bank portfolio of reserves, they've now got more gold than they have euros. And so euros have been falling and dollars have also been falling. Gold is on the up. Where does that stop? I don't know, but it could go much higher. I think Mark's report was talking about 60% in one of the pages, but you correct me if I'm wrong. And it's 20. So there's a long way to go before this happens. But why does Wall Street, and when I say Wall Street, I mean the financial services industry, why does Wall Street not own gold? Well, the joke about 15 years ago was there wasn't much fees in gold. And I think Jeroen's picked up on that point. You know, maybe BlackRock make a little bit in the ETF, but it's really small beer compared to what Wall Street's used to. Yeah, so no one really makes money out of gold in the financial system. So that's one of the reasons they don't like it. But it is very strange, because, you know, private investors are pretty happy to, you know, explain what's going on, and they're pretty happy to own gold, and the central banks get it, but the institutions don't. They're the missing link. So yeah, I think I'm repeating what the other fine people have said. So let's move on to Bitcoin.
Let's move on to Bitcoin, indeed. Well, I don't know who to turn to first, but I am curious, maybe Mark, to ask you, when it first started to creep into your consciousness, because the In Gold We Trust report was obviously hugely focused and dedicated and celebrated to a single asset in that way, but now does dedicate a chapter, and the fund that you run includes digital gold, as you call it, as well. So what sort of changed your mind? What got you interested? What converted you to including it in the same bracket as gold?
Well, from today's perspective, I guess one could say Ronnie and I found Bitcoin relatively early on. We didn't find it was that early back then, but it was 2012 when we read about it, and I think even 2011, 2012 invested some small portion, because we understood basically the monetary part of it pretty fast, actually, the monetary vision. I mean, the problem I had initially was believing that first of all, that it could really get as far as it now has. So that seemed a little bit a stretch back then. Also, the prices which would imply a Bitcoin ascending to some kind of a monetary reserve asset were just feeling too good to be true, as kind of coming from a market perspective. It's to me actually never ever happened again that I found something so early and really like kind of could rationalize a huge kind of return potential, and it actually played out that way, more or less. Yeah, that was like, it was an experiment in the beginning, and we understood you don't need to bet the house on it, because if it actually really manifests itself, the upside is enormous. So I always saw it kind of as a call option without negative time premium. So that's how I been playing it. And when things developed in the year 2017, already in the beginning of the year 2017, we started about thinking of integrating Bitcoin into a fund, and we wrote about our strategy in the report 2019, where by that time I think it had become to us quite clearly that there is that a peer has arrived to gold, a different kind of peer which has similarities but also differences. And I think in our article Gold and Bitcoin Stronger Together from 2019, we make the case that basically these two asset classes combined may become kind of the new multi-asset portfolios like bonds and equities, which can be allocated as kind of a bucket towards traditional asset allocations, right? To the traditional bond and equity portfolios. And that was, yeah, it is still slowly getting there, but 2022, I think Ray Dalio said, I like my gold with sprinkles of Bitcoin on it. And it is, I think, very obvious that in more and more, I think in almost every conversation about either asset, the other one pops up, right? So it always comes up together in tandem. So I think it was kind of a natural progression to think of these two assets as kind of a new asset class, hard money, non-inflatable assets, and combining them definitely makes sense from a portfolio management perspective, especially due to, I think, two specific factors. One, the correlation is still very low. It's actually, if you take a rolling correlation over the long term, it's close to zero. So that really obviously helps to diversify and get more diversification effects. And two, what's also, I think, interesting and maybe overseen a little bit, the distribution, the different distribution of the returns also, I think, is quite an interesting, makes the case for the combination as well, because Bitcoin has a little bit a distribution on the right hand side, so it's an asymmetric asset, and gold is more symmetric asset. So Bitcoin for the upside also, I think, improves the whole risk return profile of the combined portfolio, giving the combined portfolio also a little bit of a skew to the right, which is obviously what most people and most investors desire. And then if you start rebalancing and so on and thinking about these kind of things, so in our case, the derivative overlay, there are all kind of opportunities arising about the combination of these two assets. And I think, yeah, I mean, obviously we are talking here, we have all similar, I think, ideas, and I think slowly it's getting somewhere, this kind of viewpoint, but it's still a super minority, I guess.
For now, but hopefully not for long. Now, if anyone had a Bytetree Bitcoin and Gold webinar bingo card, correlations would have come pretty high, and we're going to talk about them. You just mentioned them there again. And Jeroen, I want to ask you, because a criticism of Bitcoin, or maybe something that people worry about with it, is a sort of correlation supposedly to the NASDAQ and to American tech stocks. But this is something you've recently been writing about, and I wondered whether you could talk about that for us and how actually it's not so correlated to tech stocks as you think, and the correlations, or as Mark says, are better viewed in the context of gold.
Yeah, so you see the headlines popping up also last week on my Bloomberg again. That is not a safe haven or whatever. And then every time the argument is, it's like the NASDAQ on steroids. It goes in the same way, only more. But again, I have a traditional finance background. I use traditional way of calculating correlations, diversification benefits, and things like that. If I do that and I create a simple 3-year rolling based on a weekly basis or daily basis, but weekly basis correlation chart, you will see that it was until 2 years ago, the NASDAQ and the Bitcoin were not correlated at all. So it was averaged to 0. And now it has averaged the last couple of years to 1.2, 0.2, 0.3, with 1 being perfectly correlated and -1 moving in the exact opposite direction. So to claim there's a high correlation between Bitcoin and NASDAQ is just not true, because most of the time high correlation between 0.5 of higher. And what I then do is I show a chart, in this case, between the correlation between the NASDAQ and high yield bonds, which are by every traditional investor considered a very separate asset class. But because high yield bonds have this equity part in them, the correlation is always between 0.6 and 1. So when there's a crisis, it's 1, and on average, it's 0.7. So I like to challenge those people who say that, and what they do, they compare lines, but you have to compare returns. That's the first mistake they make. And then my second question is, if you think these are two of the same, what do you then think of high yield bonds, which is a separate asset class in most of the sophisticated multi-asset portfolios consisting only of equities and bonds, because these are still bonds. And so this is basic finance, this is basic statistics. I'm no expert in that. I know how to calculate correlations, but the notion or the conclusion that these are very much the same thing is just not true. And that also pays out when you add other classes like gold, and then you have more correlations and diversification benefits to look at. But the story that these are highly correlated is not true. And other asset classes that maybe are not different asset classes are highly correlated. So this is a simple chart I put out every now and then look at some reactions and think, okay, these people don't want to get it, but that's fine. I keep explaining.
Indeed. Well, if I could get you to keep explaining now to us, is how you think about the correlations within the fund that you run. So you have quality equities, as you mentioned, gold and Bitcoin, thinking of scarcity as a key thing tying them together. So yeah, take a few minutes to run us through how you think about that.
Yeah, so the correlation between Bitcoin and gold is already explained by Mark. So it's very close to 0. And that also means that even though the trajectory on which these two asset classes are may have the same philosophy behind it, they are definitely not the same. And there's another chart which I also like to show, and that is the correlation between equities in general or quality stocks with gold. And what you see, and this is an experience, a lot of people get really nervous and start taking wrong decisions when equities go down 30, 40, 50%, or on a daily basis 10%, 5%, and then they get really scared. This is also what you saw in March, late March, April, and a little bit of May. So what I then do, not just showing the correlation chart, because that's statistical and a lot of people don't really understand it, but I take the 20 worst months for equities since 2008, including the financial crisis, and I then add the returns on gold in those 20 worst months for equities since 2008. So on average, equities go down by roughly 6%, gold goes up by nearly 3%, just below, and in 80% of the cases, 16 out of 20, gold is up. I also, because of the whole bond thing, I added the return on bonds in those 20 worst months for equities. The return is negative. It's minus 0.1%, but it's negative. There is no diversification benefit when it comes to big drawdowns in the last since 2008, which is now 17 years, coming from bonds. Of course, they go down less, but they go down on average. So this is a very interesting way of explaining why do equities and bonds and gold provide an attractive combination. And then I sometimes add Bitcoin to that as well, but because the Bitcoin returns are so aggressive, much bigger than all the other asset classes, you will see that people start to focus on the whole return thing, where actually the diversification benefit is the focus of that. But so this is a nice explanation also because behavior tends to take over when things go down a lot. So I think this is a very tangible example of how different asset classes can help you through more difficult market phases of market turmoil, things like that.
Perfect. Well, if we turn now to you then, Charlie, to talk about the same thing with the Bold Index.
Yes, thanks, Kit. The Bold Index was created to be a very simple solution to the problem. It was designed for the wealth management industry, which is where I came from. And trying to win the argument to own gold in portfolios was a bit of a tough one back in the day. But we did. Not all the portfolios in the firm had gold, but most of them would have a little bit, not enough. And in those days, we did come to the sort of 5-8% conclusion. And I totally agree. I think Mark was saying earlier that you could now go much larger than that. It's so obvious because the bond market's not the bond market anymore, quite the same way. So, you can have a larger exposure. And I just came to this conclusion that as Bitcoin grew up and its volatility started coming down and its liquidity started going up, it was quite obviously becoming a mainstream asset, but still not accepted. And the correlation argument made them go together. Basically, if you put, we do the risk weight by 360-day inverse volatility. I won't bore you with that now, but it's on the website if you want to look it up. And it just basically, you end up with the Bold Index has approximately the same volatility as gold, but superiorly higher return. So that's quite incredible. And that only comes because you've got this magic asset combination. You won't see that between bonds and equities, silver and gold, Ethereum and Bitcoin. You won't see it between anything. But it does exist here. So it's a unique opportunity. And I just felt that, if you get that concept, get it into a 60-40 portfolio in the wealth management industry, I'd be adding value and doing something useful. So it was a very simple idea to put these assets together on a risk-weighted basis, basically most of your money in gold, a little bit of Bitcoin, to Ray Dalio's quote. And the results speak for themselves. And so, so all three of us are doing the same thing in slightly different ways. And that's really why I wanted to bring everyone together to tell this story, because it's ridiculous that this isn't a mainstream allocation globally.
Yeah, agreed. And it is fantastic to hear from all three of you. And I hope people are enjoying, and do send your questions. We'll get to those in 1 minute. But before we do, want to go back to Mark for one last question, because you mentioned how you rebalance the fund and also the derivatives overlay that you're using. And I was just wondering if you could give us a bit more detail on that, because I was so curious.
Happy to do so, but if I just may add one more point, I think so. We, like all three of us, have this portfolio management perspective and kind of think in risk-adjusted terms and so on. But I think for a lot of investors, not necessarily only retail investors, that is, Jeroen pointed out this. I think one of the biggest problems when it comes to Bitcoin is volatility, and that's always strike me, because for portfolio managers, I think the argument that Bitcoin has a high volatility should be a non-argument, because it's the damn job of the portfolio manager to do a position sizing and basically get in the right position so that the overall position suits the risk of the client, right? So it's a non-argument, but in practical view, it is an argument, because due to the high volatility, I think the behavioral finance problems coming with this high volatility are really high. So if you are down minus 60-70%, you just really, it's a difficult. You're in a difficult spot. Also, if you're asset manager for other people's money, you don't want to have to kind of explain why you have only even a 2 or 3 percentage points position of these assets, which is down in, I don't know, 2022, for example, 75 percentage points, right? So I think really the combination not only increases risk-adjusted returns, but at the end of the day, it helps the investors basically sticking to this allocation, because it makes it more bearable for the investors, because they don't have to take the brutal drawdowns, even though if it's only in one single position. And I think that's a big argument for the combination in practice, apart from what we've been talking about. So having said that, back to your question. So rebalancing, when we started our first strategy, we actually have two similar strategies. We were thinking about, okay, what kind of combination, what kind of strategic asset allocation should we go for? We looked at all kind of different combinations, what we found, and we basically didn't look at risk in terms of volatility, but we looked at risk in terms of max drawdown, because I think that's the more relevant parameter in that case. And the back test back then, I think that was 2019, showed 8 percentage points Bitcoin and 92 percentage points of gold would have produced a minimum max drawdown portfolio. Which probably was a little bit higher back then, because volatility was higher in the first part of Bitcoin's existence. It would probably be now a little bit, so the Bitcoin allocation now would be a little bit higher if one would want to go for the minimum max drawdown portfolio. But we consciously went for a little bit higher allocation, and we went for 25 percentage points Bitcoin and 75 percentage points gold, so that we have capture more of this asymmetry, more of this upside, which I was talking about, and still are in overall terms in a volatility range which should be able for traditional investors to tackle. And that's how it actually turned out to be in the live track record. So we have a volatility of 2025 roughly. So that's like an equity mandate, I think. So and also in the drawdown 2022, where we were live with both strategies already, I think that the concept got proven in that we really didn't have significant redemptions. So our clients actually were able to take the drawdown. They stuck with the product and recovered, and more than recovered by now, obviously, right? So I think that really showed us that this product adds value not only from a risk-adjusted portfolio point, but also from a behavioral finance portfolio point. And your last question, so rebalancing we do on our not on an interval basis, but on an event basis. We don't want to rebalance just because it's the end of the quarter or what have you. We rebalance only if our allocation gets too much out of whack. And we saw that 40% on the upside when it comes to Bitcoin is a good mark, and 10% at the downside. And by that, we don't have that many rebalancing events, which means our trading costs are not high in that sense. And also the rebalancing bonus, there is actually something in financial literature called like that. The rebalancing bonus is the higher the higher this bandwidth of this rebalancing leeway is. So the trade-off was basically maximizing the rebalancing bonus on the one hand, which would have basically spoken for high bandwidth, but on the other hand, providing some kind of a stable risk return profile. If you leave like Bitcoin between 0 and 100% in an extreme case, the investor doesn't know what kind of risk return profile he has in his or her portfolio. So that's why we basically cut off the allocation at 40 percentage points on the upside and 10% on the downside, and that gives you all the time kind of an equity-like risk return. I think you, still asked about the derivatives just very shortly. So when we approach the 40 percentage points of Bitcoin allocation, we can basically write riskless calls. So because we know pretty much where we're going to have to rebalance, and we write covered calls with an allocation of what we are going to have to sell anyway. So we commit ourselves to selling a part of our Bitcoin exposure in case of a further increase of the price. So we don't know if it will keep increasing, but if it increases, we have to sell anyhow due to our rebalancing methodology. By this, we actually can incrementally gain some premiums, which I find quite interesting because, as I already mentioned, the main critique towards gold and Bitcoin to some extent is it doesn't pay any return. And by basically collecting premiums, we now combine gold with Bitcoin, rebalance, and put on derivative layover on top. We can have some kind of cash flow. So this is, I think, quite an interesting concept.
Perfect. Yeah, interesting indeed to hear about the covered calls too. Now that has been fantastic from all three of you, and we've got some good questions coming in. So I'm going to turn to those now. And the first one does relate to what we were speaking about last week as well, Charlie. So maybe I'll start with you, but I think we want to hear from everyone, which is if the world continues to de-dollarize over the next few years, do you all believe that capital controls could be imposed in America and possibly other Western countries? And if so, what would these actions mean for the prices of gold and Bitcoin?
Well, I can't think of many assets that would enjoy them more. Capital controls are an event, which you could say that the environment is higher risk than it was, and that's absolutely true. And indeed, this new bill by Donald Trump is got a clause for that. So it is an increased risk, absolutely. And I think one point that probably hasn't come out, but it's really obvious, but I'll make it anyway, is that gold and Bitcoin are neutral assets. They're globally neutral assets. And so no one can really control them in quite the same way that they controlled other assets. You could say that gold bolted, the vault is bolted down. You can own your gold somewhere else and that kind of thing. The Bitcoin certainly is not bolted down, which is one advantage it has. But these are global neutral assets. It's in no one's interest to interfere with them, and they're the two most liquid alternative assets in the world. So this is really important. So I just think they're absolutely the right thing to own in that unlikely environment. Well, I say unlikely with a bit of hope.
Great. Maybe over to you, Jeroen, and then you could add how quality equities might respond to that as well, if you like.
Yeah, well, I think at some point you will get some version of capital controls, not only because of de-dollarization, but also if you look at the budget deficits of governments, the worst thing they can handle is taxable capital fleeing their country, right? So at some point, governments will try to prevent capital from leaving the country or area. And of course, under this US regime, that's also going to change, of course, at some point again. But I can imagine that if the de-dollarization accelerates, and it seems to be happening, also because of the US's own policies, that there will be actions. I don't know if that would qualify as capital controls, but there will be legislation or whatever, more tariffs, I don't know, to prevent capital from going out of US treasuries, dollars, and things like that. So I think that is very feasible. And even if you do not have a very doom-like scenario, I think it's very wise to at least embrace this possibility in your portfolio. And again, that does not mean that everything has to go down or that the dollar is going to zero or whatever. But I think it's a very obvious possibility looking at what is happening in countries like China. China wants to get rid of the dollar, but it doesn't have a strong currency itself. So it can only go away to gold. So why should you in your portfolio not do the same? It's I think very obvious. And then gold and Bitcoin are the two obvious candidates for what Charlie already has said. These are neutral assets. It's very difficult to catch them instead of money sitting in the bank, dollar sitting in the bank. So I think your multi-asset portfolio is a reflection of what is happening in the world. People are moving away from the dollar. Why should you not do the same thing? It's very straightforward without expecting any very bad things to happen.
Great. And finally, same question to you, Mark.
Well, not much to add. I think just perhaps that first of all, nothing can be ruled out, generally speaking, and especially not in these kind of times. So yes, definitely a possibility. Perhaps just one thought. I think it's not necessarily a binary state. You know, nobody will ever come out and say we are going to implement capital controls. That's not how it works. I think it's like more like financial repression, and that is already here to some extent. Always has been, because we have interventionistic governments, and if you start taxing, I don't know, foreign returns a little bit. Is that already capital controls? You can argue about it if you know. So this is more and more interventions, I think, are to be expected.
Yeah, indeed. We're seeing it in this country with what they're talking about, pushing pension funds to invest more in UK assets, and that clause in the big, beautiful bill, 899, I think it is, exactly. Another question relates to what I guess you don't all consider as a competitor, but is one of the big names in terms of investable Bitcoin strategies, and that is Strategy. I don't know if anyone has any comments. The question is, how much of a threat does it pose to the price of the asset?
Well, MicroStrategy, the stock, you mean?
Yeah.
I'll take that. I mean, we've got Jeroen and Mark. You may not be aware, but the UK regulator has signaled that the Bitcoin ETF ban is ending soon. And I spent a lot of time looking at this, and the ETF ban is in India, China, Japan, Singapore, Thailand, you name it. There's so many countries, even places like Ireland, which are EU, so you can trade it in Germany but not in Ireland. Why? So there's been inconsistency about this. And I think that if the UK regulator breaks and allows Bitcoin to be traded in ETF, then that will go a long way to reducing uncertainty, because many companies' financial headquarters are in London, particularly on this side of the world. And I think that the Bitcoin ETFs will grow rapidly in Europe. At the moment, all the growth has been in America, then the growth will now come to Europe, much faster than we've seen before. And then at that point, what is the point of a Bitcoin treasury company if you have free legal ETFs? You know what I mean? No one does it with gold. It says, I put a whole lot of gold on my balance sheet. I mean, why would you do that? If you want to buy gold, you buy gold. So now you'll be able to buy physical Bitcoin. There's no such thing as physical Bitcoin, but you know what I mean. Bitcoin in a wallet, or you'll be able to buy an ETF. And so I think the case for these treasury companies is pretty weak, and they're high risk investments. If I'm right about that, then MicroStrategy goes from 100% premium to 50% discount, just like GBTC did at the US ETF. Is that bad for Bitcoin? I'm not sure how much it impacts Bitcoin. It only impacts Bitcoin if they start selling.
I have some thoughts, if I may add. I think this is a very interesting topic, because, and the question is a good one and a relevant one, because obviously the volumes that especially Strategy, as they are called now, are holding are quite significant, and there are also more treasury companies being implemented in the last year, actually. So these are relevant players. I mean, I disagree slightly, Charlie, insofar that I think there is a case to be made for like, I see MicroStrategy as kind of a financial engineering company, which basically provides the big pools of assets with securities. Like, for instance, if you look at this very successful emissions of convertible bonds were bought by Allianz, for instance, by the bond portfolio management of Allianz. And I doubt that they would have been able to buy the ETF, right? So they've been kind of converting Bitcoin exposure into securities. and basically tapping into the demand of financial investors, and so far being able to sell these kind of securities with a premium and reinvesting the premium into Bitcoin. But to the question, I think in its core is the question is relevant, because the question as investors, I think we should ask is ourselves, is it some kind of an extra risk to Bitcoin? Well, then one has to distinguish like Bitcoin and network, the protocol. I'd say definitely not. That's immune to these kind of things, but kind of potentially to increase the next potential drawdown of Bitcoin. And I've got here a little bit of a contrary view, or relative at least to the typical Bitcoiner in my experience. They expect a declining volatility and also declining max drawdowns. And I don't necessarily expect that due to developments like that, because at the end of the day, they do take leverage, and I agree that they could go to a discount pretty easily again, as you said, Charlie, especially then if they are not able to refinance their debt in 2029 or whenever that comes due, and we're happening to be in a bear market at Bitcoin at that time, right? Because nobody will basically buy their securities with a premium, and then they will have to basically sell their reserves, which is Bitcoin. So there is a potential to a downward spiral in a big drawdown if a lot of treasury companies hold a lot of Bitcoin.
Interesting, thank you. That's one way into the space, what strategy you're doing. And another one, there's a question here about the gold miners, but I wonder, the Bitcoin miners, is a similar relationship to the asset we've been describing. Does anyone have any particular thoughts on the performance of the gold miners or of Bitcoin miners in 2025?
Off topic. Yeah, off topic.
Off topic.
Gold miners and the Bitcoin miners.
The only thing that I can say is, and I get this question a lot, why do you not invest in mining stocks, gold mining stocks? And my answer is always the same. These are not intrinsically scarce. I only want things that cannot be. So I don't know how many Canadian gold miners there are, and how many go bankrupt, and how many resurrect again. But this is something, it's a totally different ball game from what I think that people should do, and that is invest in things that cannot be printed or issued, or in this case in companies launched. And coming back on the strategy, I think that Mark has a good point. You can also, I think, make this very plain vanilla. I think there's much less discussion on why, in the end, if you invest in gold, most people, when you explain it to them, they understand that you want to have physical gold. You want to have it, own it in a vault. So every time you put something, in this case with leverage, but something that is a derivative in between, it immediately, by definition, increases risk, even though it can be a great company, even though it can be the standard for adding Bitcoin to the treasury part of your company, or in this case, maybe become the treasury of that. But in the end, it's a risk of a company that can go bankrupt to 1,000 different reasons. You put that in between of the actual asset you want to own. So that is you don't have to have any opinion on strategy to still think that this is adding a little bit more risk to the Bitcoin price development, not the protocol indeed. And then you don't have to say anything about Michael Saylor, and still understand that it's a derivative in between. So that's why I think the more you have it, the more you have them, the more at some point they will pose risk, maybe temporarily, but on the development, the price development of the underlying asset, in this case, Bitcoin.
Perfect. Thank you very much. Well, I think that wraps up our conversation at around an hour. I mentioned at the start your Twitter, Jeroen and Mark, the In Gold We Trust report. I think we know about those, but where else, if people wanted to find out more about your funds and your strategies, should they go and look?
Shall I start? Okay, if you want to know more about the fund, you type in Blokland, that's my last name, fund, blokland.com, and then you will end up where you have to be, or you go to Twitter, that's JS Blokland, but in the end you will end up at the website, or you can ask questions directly, of course.
Right, so Incrementum can be found at incrementum.li, Liechtenstein-based company. We provide usage funds for European investors, very easily investable, and also an alternative investment fund for professional investors. And yeah, I sometimes tweet at Mark Valek is my handle, but incrementum.li, all our funds, plus also our In Gold We Trust report.
And I just like to say, so anything to do with ByteTree will be, and hopefully all of those details will be in the show notes of this video. But I really like to thank Jeroen and Mark for your time. It's been excellent. Thank you.
Thanks for the invitation.
Perfect. Well, thanks everyone who tuned in and watched and listened as well. Hope you enjoyed it as much as we all did, and we'll see you next time.